The Albanese government's first budget will post a slimmed down $37 billion deficit for this financial year before falling deeper into the red in the years leading up to the next election. Joining us now is Scott Phillips, Chief Investment Officer at the Motley Fool. Good morning to you, Scott. So what do you make of that? Yeah, so a smaller deficit, but then it balloons on out. I wonder if that's going to be a problem as it leads into the next election.
Pete, good morning. Yeah, it's been said many times in the past, but it was probably not a bad election to lose for the outgoing government.
Yeah.
I'm sure they'd rather still be on the Treasury benches, but given the challenges they've got, look, as you say, we are right at that pivot point right now. It's probably a good time for a budget because the economy is doing reasonably well up to this point. Inflation, of course, is super high. People are struggling with interest rates, so I don't want to minimise that. But the reality is GDP is growing, unemployment is low, government coffers are full. This is where we've been. The where we're going story is the really big one because we all know the economy is going to weaken. That's literally what the RBA is trying to do, as we've said before. So, yeah, it's a tough old budget. It's going to be hard for the Treasurer to try and spin, hey, look how much money we just raised. By the way, we're going to have tougher times ahead. I can't spend all that money on you. I'm really sorry. And, of course, the reality is the RBA is trying to slow the economy. They're trying to dampen demand. So the government's got to find path to tread. They want to go and help people with cost of living pressures. On the flip side, they can't afford to do too much more because if they do, they end up working out cross purposes with the RBA, stoking demand at exactly the time they want to reduce it.
Such as what happened in the UK.
Well, that's the challenge, right? And so if you think about the way the financial markets responded to that combination of issues. Now, energy prices specifically were a very, very different story there. We think energy prices are here. Some of the UK prices are just out of control. So they had some different issues, but you're absolutely right. The government there trying a few different things that completely got the financial markets off kilter. Couldn't convince the public that even though there were some benefits there for them, this was responsible governance. And as I said, the markets clearly hated the idea. So that's what you get if you get this badly wrong. This time around, it doesn't seem like, at least from what we've heard, the current Australian government is looking to do anything quite so extravagant. But you're right, those are the sorts of risks that governments face, both politically and economically on behalf of the country.
Still huge revenue from resources, Scott, $100 billion. Is it fair to say that coal and iron ore has saved this budget?
Yeah, it really is, Pete. This is, and look, you know, Josh Frydenberg in his last budget as Treasurer expected the iron ore price to be much, much lower, about $55 a tonne from memory, I think was the estimate.
Yeah.
I said at the time, I'm pretty sure I said to you, it was the right thing to use because it was a conservative approach. I do think over time, by the way, the iron ore price continues to fall, but it's been a great thing for the budget. Coal prices as well, record coal prices, particularly out of the port of Newcastle, over $400. These are prices that frankly, I think are really unsustainable. Now, you know, whether they are or not is an open question, but you're right. The government budget is going to do very, very nicely. Thank you very much. And that probably does underscore the challenge for the government and for lawmakers generally. We have a structural deficit that neither party's been prepared to actually face and fix. Right now, it looks better because those commodity prices are high. But as you say, reverse that. Take out that $100 billion odd, mate, and this is a very, very different looking, not only for a future budget, but the past results as well.
Let's turn our attention to China, Scott. Stocks have plunged 20% after Beijing's power reshuffle. A significant drop there. What does that say about the new Politburo?
This is fascinating, Pete. You and I talk regularly, and occasionally I shake my head, either metaphorically or literally, at what the markets tend to do. Everyone expected Xi to retain power, to go to a third term, to effectively have his position as president for life, or as long as he can retain power in the CCP, to be maintained, to be confirmed. So this shouldn't have been particularly surprising news. But in Wall Street in particular, some of those US-listed Chinese stocks have fallen 14, 19, 20%. On the back of concerns about what that does mean for how investable, to use a horrible word, these companies are for investors. If you look at the sorts of businesses they're doing in the jurisdictions in which they're doing them, we used to think about sovereign risk in terms of African countries, for example, or Asian countries where maybe the economies are less developed, maybe power structures or governance rules are less enforced. This is the exact reverse. This is the sense that the CCP, the Chinese Communist Party, pretty much always has had, I suppose, absolute control. But Xi taking his third term probably suggests this goes from a one-party state to a one-leader state.
Yeah.
Dictatorship is probably too hard a word, too strong a word. But the reality is investors simply saying, look, we don't know what happens next. We don't know what Xi may or may not do. based on the fact he's now effectively confirmed as president for as long as he wants it.
Yeah.
Whether he will ring in further changes, that's the big question. As we said before, mate, markets hate uncertainty, and those Chinese, US-listed Chinese stocks have fallen.
I don't think it's too strong a word to say he's a dictator. I think that's exactly what's going on there, Scott. That's just my view, though. But let's bring it home now and finish here. Shoppers being warned to expect higher prices at the checkout once again.
Yeah, unfortunately, mate, there's so much of this data around, and it really isn't a surprise, I suppose. It just is always stark when you see these numbers in black and white. Of all the major food categories that we saw a research report out yesterday, only pork, seafood and fruit and veg have fallen at all, but still up on this time last year. So we're getting sequential rises month on month on month, and year on year, everything is up. Now, fruit and veg coming back is probably good news in the short to medium term. That's a lot of supply coming back on stream after having some disruptions for drought and floods. But of course, we also know that some of the flooding in eastern Australia, down as far as Tasmania, is really going to impact on crops. So I think that benefit's going to be short-lived, unfortunately. Meat continues to go higher, packaged goods continue to go higher, and we're seeing really significant inflation, 6, 8, 10, even 15% on some personal care products in supermarkets. Again, people know that. They've been to the shops. They know how much these things are costing. When you see it in black and white, though, it really does ram home just what a challenge the RBA has. So
the Christmas ham is going to be much more expensive this year, Scott.
I think it will be. I think that's going to be the challenge. I mean, look, honestly, you know, we're in this sort of situation where month-on-month inflation, it's not just quarterly or yearly inflation. You know, we used to talk about yearly inflation of, 1, 2 or 3%. We're seeing monthly inflation of those sort of numbers in some categories some of the time. Not sustained, but, month-on-month, yeah, you're right. Look, 2 months from now, literally 2 months from now, how much does ham cost? How much does pork cost? How much does turkey cost? Yeah. These things are going to continue to rise, I think, for the foreseeable future. That is, as I said, the RBA's challenge. It'll go well into 2023 as well, as will rate rises. We saw numbers yesterday about the potential for up to 20% house price falls in the RBA's own numbers. And that result, that outcome would be specifically because they have to push rates up harder than they expected because inflation is just harder to tame.